with overly aggressive expansion. There was a lot of disaffection, it seems to me. Again, I was just a spectator over what the company's results were, rather than what the company's emerging market commitments might have been, which is a sign of the times in terms of the tenure of chief executives in the United States. And one of the other things we could obviously talk about is increasingly it's a short-term job.
Well, on that note, unfortunately, it's a short-term panel as well, so it's our time is already up. Thank you both, Roger and Tom, for having for being such a stimulating panel. And this conversation could certainly go on a lot longer. Thank you very much. We now have a brief video to introduce our next panelists. So I'll leave the stage. Great. Well, I think one of our themes at most of the previous Buttonwood gatherings has been to be very bullish about the BRICS and the rise of the emerging markets and so forth. And I mean, broadly speaking, that bullishness has been well placed. But there is this year has been a tough year for the BRICS. Lots of money in the summer flowing rapidly out of most of the BRIC economies. And this panel is really going to focus on, was that a blip? Were the BRICS, are the BRICS crumbling, as the title of this session suggests, or is there, as I suspect, a more subtle story underway? And Joyce, give us your sense of how worried should we be by what we've seen this year?
Well, I think some of the market correction we saw was an overreaction. And if you actually take a look at market performance since the Fed delayed tapering, you're back to having emerging markets outperforming developed markets. So I think there was some overreaction because there had been so much money going into emerging markets that you'd had really a one-way story for a couple of years. I mean, I do think you're going to have more volatility going forward. And I think that the sell-off was just as much a test of the market liquidity. I think investors are asking more about how easy it is to get out of emerging markets as well as get into emerging markets. So we're forecasting emerging markets growth this year at 4.3%. We have emerging markets growth, potential growth at 5.2%. So it's below potential, as is developed markets growth. We have this going up to only 4.6% next year. So still below potential. But even with those numbers and an improvement in the US economy, emerging markets will still be over 50% of the contribution to global growth next year. So I don't think the core story really is different. And what we have not seen in the sell-off is that there is a systemic crisis, a systemic balance of payments crisis. And we've also had a return of the flows. We see EM FX reserve accumulation resuming again in the third quarter of the year. Also record issuance by emerging markets, corporates, and sovereigns during the month of September after having severe outflows in June. So I think the story is still intact, but the real reality of the financial crisis is that you have below potential growth in both developed markets and emerging markets. That all of this unconventional monetary policy has not necessarily translated into higher growth numbers.
And I mean, the next panel is going to be talking about frontier markets, and I guess we're expanding our definition of BRIC to include maybe also Turkey and Mexico and South Korea and maybe South Africa on the borders. I mean, does this definition, does BRIC actually tell us anything meaningful now, or is the individual story of each country actually a more important thing to focus on than the category as a whole?
Well, I've always thought it's more country specific. And I think that the decision making about how you're going to invest is going to be more country specific going forward. And I think investors will be looking at hitting singles rather than doubles. Where do they see predictability of policy, adequate cushions, political continuity? We have a really heavy election calendar next year in the emerging markets countries. So I wouldn't necessarily just limit it to the BRICS. And frankly, for all of the concern about the China slowdown, the real dramatic surprises on the growth side were actually from the other countries. It was the Brazil with a 2% handle, bringing India down to 4% growth, Russia down to 2% growth as well, below 2% growth.
Let's talk a bit about Brazil. I mean, we on The Economist, we had a cover story a few years ago of the rather blasphemous cover of the Jesus statue taking off as a rocket into the atmosphere, and then we ran a cover more recently where the rocket appeared to be spinning out of control back to Earth. I mean, what is going on? How much recidivism? How much is Brazil going to back to bad old ways?
Well, I must confess that when I saw the Christ in The Economist, I was concerned. It looks like too much, too excess optimism. Maybe now we are too pessimistic. Maybe the markets are too pessimistic now. But what's happening in Brazil is that I think Brazil and some emerging markets need to reinvent themselves, to change, to rebalance. The story is you had 8 good years, maybe 10 good years, in terms of trade up, boom. Then it was over. Then you use all your ammunition for credit, fiscal expansion, monetary expansion. When it's over, you have to face reality and you have to rebalance. In the case of Brazil, we're talking about an economy that's already in full employment, wages at high level. How can you grow? You need to redirect to investment, infrastructure. You need to do reforms. You need to, in the medium run, invest in education. At the end of the day, what we're talking about is rebalancing. And what Brazil faces is the pains of rebalancing.
And, I mean, give us a sense of the political risks as you see it for Brazil. Because, I mean, there is this real frustration with the current administration and the sense there's a lot of corruption, a lot of pandering to the left and so forth. I mean, is that something you worry about, that there could be a real reversal or paralysis of the reform process and modernization?
Well, I'm more concerned of not having the changes that you need, that mean more reforms, more changes, than the opposite of having too much changes. An economy that is fully employed, and everybody's at the highest level of wages they had in the last 10, 15 years, the risk is of not changing, not the risk of changing too much. So my concern is that we are not going to do enough reforms to generate the productivity, and maybe you'll continue to grow 2.5%, which is the rate of growth we project for this year, maybe 3%, but it's not high enough for our BRICS.
Now, Stephen, China, the leadership transition seems to have gone pretty well. Where do you see the big upside opportunity, the big downside risks as you think about China for the next couple of years?
Well, you guys do a great job of writing about the downside risks every week, so why don't I just focus on the upside. The strategy is pretty clear in China, and it has been for some time, and that is shifting the model from investment and exports to one driven more by internal private consumption. China, the producer, morphing into more of a consumer society. It's been a top-down, rather vague strategy up until now. And the new leadership really has a pretty clear opportunity at a major meeting that will begin in Beijing in less than 2 weeks to lay out some specifics on the reform proposals that will really take the strategy down into the trenches in terms of implementation. And there's lots of rumors that they'll touch on things like further liberalization of the capital account, the currency policy, the household registration system, flesh out the new urbanization strategy, some of the deposit interest rate liberalization we're looking for. I'm personally hopeful they'll finally begin to tackle some of the tough issues on the social safety net. But this is all guesswork, and I do get a clear sense in talking with very senior Chinese officials, and I was there last week, that they know this is their opportunity to seize, and the package that's going to be presented will be fairly comprehensive and more detailed than we've seen in the past. And so moving from strategy to implementation is the challenge. If they don't do that, and it's just sort of getting stuck in a rut, inertia due to special interest groups, then there is downside. The downside is a downside of unwillingness to really buck the special interests. And yet, you look at what the new leadership's done this year in terms of going after, I counted them up the other day, there have been 10 major officials brought to account on corruption issues.
Now, and are those corruption campaigns, I mean, are genuine? You think they're not just taking out people from the other camp who survived in key positions and settling old scores and so forth?
Look, I don't really know, Matthew, but I think it's not unsurprising in China to see them go after the high-profile cases and really not tackle the more difficult local government and local official. They make the distinction in China between the tigers and the flies, and they got to go after the flies. And there's the guy who's really driving this corruption and so-called the discipline campaign is a very savvy, well-experienced economic reformer, Wang Xishan, and he is very capable, very competent, and we'll see how this goes.
And I mean, obviously earlier this year there was a flurry of excitement about the banking system in China, and is there a big more of a black hole there than people thought? I mean, has that all settled down a bit now? Is that?
Well, number one, it's the credit intermediation system in China is like Europe. It's hugely bank-centric. So you're right to focus on the banks, and there are a couple of issues that need to be addressed. The exposure of the banks to these local government financing vehicles that really played a key role in driving China's response to the crisis, and then the emergence of these so-called wealth management products driven by the so-called shadow banking system in China, which are really an outgrowth, again, of an interest rate that is not set in a way that provides market-based returns to depositors, and so they rush into these products. So these are two issues that need to be addressed. I think they're dealing with the former one, the NPL risk and the exposure to local government financing fairly effectively. We'll have to wait and see how they deal with this wealth management issue, especially in the aftermath of this meeting in early November.
Joyce, any disagreement with Stephen on China?
Well, I think the numbers in China on the financial system are getting more worrisome, so the market's going to remain focused on them. I mean, shadow banking, that's 70% of GDP, corporate debt, 124% of GDP, total social financing, 200% of GDP. But I think that the Chinese government, they're not facing an imminent hard landing, but they will have to let some stress show, I think, in some of these products in order to have investor behavior change and migrate back to the better banks and out of the shadow banking system. That's what worries me. Could you continue to have some just increased market volatility, which can be managed, but it could cause the markets to be alarmed, just like we saw overnight rates spike over the summer. So I think this is something that it's not a bank solvency problem. It's something that China has the ability and is highly aware of, that they can't really rebalance their economy without fixing the banking system. But I think the episodes that we saw over the summer, I mean, you could see this recur, just as you could see the emerging markets, more volatile conditions with us to stay, even though I don't think the underlying thesis has changed.
And now, I mean, obviously the other perennial rival of China, India, we've had on our cover several times, India versus China. They've had their rupee crisis and lots of other things going on in the last few months. And I mean, do you think Mr. Modi is going to be the answer there?
Well, I think that I think the Reserve Bank of India has taken some pretty aggressive steps here to try to show that they're going to rein in the fiscal deficit. They're trying to address higher inflation, that they're aware that they need to address the capital account. You know, the current account's been addressed with gold imports, but just with what's happened with gold imports. But I think there's a high level of awareness of the problem, that they need to take this moment and put some changes in. I am concerned that, you know, the political calendar there, the state elections heat up relatively soon, though, and that is going to be challenging for them.
Matthew, I mean, I don't really want to pick on the host organization here, but I just remember this fantastic cover on The Economist, which I read religiously, of course. It had these two arm wrestlers on the cover, both muscle-bound, you know, and you know, this young Indian stud, you know, starting to pull down the arm of, you know, the Chinese arm wrestler. I mean, you guys got to go back and take a look at that cover story. I mean, this Indian guy was on steroids, and he's been drug tested, and it's no longer a contest. I mean, India has really gone into a real funk in terms of managing its budget, its current account, and you have this Crumbling BRICS title here. I mean, the poster child of the crumbled brick is India. I mean, you know, the rupee collapsed, the stock market went way down, in large part because this was an economy that has mismanaged its opportunity on the road to reform for a decade.
So do you think Modi is the answer? Yeah.
Well, I think it's going to take I agree with Joyce, it's going to take a really tough resistance to these political forces that have frozen reforms for over a decade. The current leadership in India has been a huge and massive disappointment in that respect.
They will change the cover, as they did in Brazil.
Back to Latin America. I mean, I was in Chile recently, and there's nervousness about the change of government there, and maybe a more left government than there's been in the past 30 years in Chile. There's Brazil having its problems. Mexico, on the other hand, seems to be better than expected. Colombia, again, some worries. How do you weigh up the region and the opportunities versus downside risk?
I think the region is prepared for the crisis of the past, the financial crisis. They have reserves. If interest rates go up, I think we are ready to intervene. I think I'm more worried about the crisis of the future. We just talked about China. If for any reason, and I don't believe it will happen, but for any reason we see a deceleration in China hard landing, then it's the real problem for Latin America.
Because so much commodity
Because you
export
have,
is going.
in terms of trade, all the commodities, a big partner. The countries you mentioned have all these, they are looking at the Pacific, they have the alliances, they are open. Those are the countries that I believe will do better because they are open, they're investing, they have trade agreements, they're looking at the Pacific, they're looking at Asia. Mexico is different, Brazil is different. Mexico, after decades of relatively low growth, now they are in the pace of reforms. They have reforms. The market always expects more from the reforms that democratic governments can deliver. So you start with 100% of reforms, you end up with 50% of reforms. And the market is disappointed, but at the end of the day, 50% is good enough. In the case of Brazil, you need the reforms. You had relatively good performance in the last 10 years, not in the last 2. So I don't know if you have the political will to do the changes that you're doing in Mexico.
Great. Well, let's have some questions from the audience. We have about 10 minutes left. Who'd like to go first? Gentleman in the middle there. Again, if you'd say who you are, it'd be great.
Hi, I'm Cody. I'm a student from Winnipeg, and my question is the BRICS, is there fall in GDP, is it caused by a weak domestic or foreign demand? That's my question.
Joyce.
So last year, when everybody was in love with emerging markets grew 4.6%, and it's 4.3% this year. So a lot of this, in my opinion, is a change in perception. I mean, emerging markets growth seems to have peaked post-financial crisis in 2010 and to have come down. But if you look at, and something Elon can expand more on, in Latin America, what has driven growth? It hasn't been capital flows. It isn't the easier external conditions. It's usually been the export growth. So that does go back to final demand coming from the developed market countries. And then there is this rotation, which, as Steve has talked about whether you're getting this rebalancing where it's more, the domestic demand conditions. So it's hard to generalize across emerging markets, but I think that, the reality is for so many countries, whether it's emerging or developed markets, you've had just this very easy credit, unconventional monetary policy, and that has not translated into growth very readily. I mean, we're in a period that still, things like financial repression, lower potential growth in DM and EM is probably here to stay for a while, given the magnitude of the crisis that we went through.
Because it was striking earlier in the summer that it was pretty much immediately after the comments about tapering from Bernanke that you got the big withdrawals from the emerging markets, which suggested a pretty high degree of integration still.
Well, Matthew, you got to make the distinction between the ones that were hit the hardest were the ones with large current account deficits or erosions in their current account, like India, like Brazil, like South Africa, like Indonesia and Turkey. China was not hit by this as we fondly refer to it, taper talk. When the interest rate arbitrage looked like for a nanosecond before the Fed got cold feet, was going to swing back to the U.S., those dependent on those flows, and here I'm a little different than Joyce, got hit very hard.
But I would just like to add that I think market liquidity had a lot to do with this. I mean, if you look at emerging markets trading volume, half of the volume traded is Mexico and Brazil. And they both kind of came off about the same amount, even though they're quite different. I look at Brazil, I think the fundamentals actually look quite a lot different than South Africa or Turkey. The current account is much smaller. I mean, they don't have a capital account issue, but I think part of this is market liquidity, and this is a test of market liquidity as well. I mean, there are some realities post-financial crisis. The dealer inventories that are being held right now for bonds, it's much smaller than it was pre-crisis. So if you take a look at dealer inventory and the ability to act as a shock absorber, probably there's a 75% decline in the positions that were held now in the dealer community versus pre-financial crisis. I mean, the dealer community, if you look at the public data, holds about 0.5% of the bonds outstanding right now. So you've got that more volatile market conditions and the fact that for emerging markets, local government instruments, about 5 of the countries, the biggest countries, are the vast majority of the trading. So, I saw what happened in emerging markets as being a repeat of some of the trends I've seen previously. You sell what you can, not necessarily what you want to sell. And China is something, at least in the fixed income market, where it's not a really tradable market.
But would it be reasonable to presume that whenever the Fed rediscovers, as presumably it has to eventually, a need to do something about QE and to start raising interest rates and so forth, that at that point emerging markets will be the first people to feel the pain? And
well, I have a different view on that. I'm more worried about not tapering than tapering. Because not tapering means either one of the two. The advanced economies are not growing, especially the US, which is worse for emerging markets, or the Fed is behind the curve, which means that the advanced economy US are recovering, but they decided not to remove the stimulus. Not removing the stimulus when the US is growing means that at some point, you'll have to raise interest faster. And if you do it, that's a real problem for emerging markets. So I'm more worried about not tapering than tapering.
So we've got a couple of questions down the front here. Let's take both of them.
Hi, Roger Bliss from RBC Capital Markets. Could you guys maybe handicap the impact of environmental issues in terms of the growth trajectory for some of the countries we're talking about, especially given the recent news in Beijing around warnings to stay in, and in other parts of I guess the BRIC world?
Let's take the other question as well, and we'll have both
And
answers.
Stanislav Andreev at Citi. A question for Stephen. I was wondering if you can touch on the business climate in China. There's been a couple of notable cases, I guess, most notably GSK, which made a lot of foreign executives, especially Western executives, nervous. Is that a trend that we're seeing, and what does it mean for the Chinese climate going forward?
Do you want to take both of those, Stephen?
Sure. Briefly, I was in Beijing last week. I was prepared to, hunt for a supply of oxygen. And I was very surprised, at least on Thursday, Friday, and Saturday. I can tell you the sky was bluer than it is today in New York. Maybe they manufactured it. It's hard. It's possible, but nevertheless, further north in Harbin, the city was closed. There's a serious environmental problem in China. There's no question about it. And this definitely has the attention of policymakers. The trade-off between environmental degradation, whether it's air and water versus economic growth, is critical. I think part of their willingness to accept this slower growth, one that is driven more by services than resource and carbon-intensive manufacturing, is aimed at trying to get at this from a slightly different way. They're making massive investments in renewables. They do have some pilot projects in terms of carbon trading that are up and running now in Shenzhen and in Shanghai, ready to start in Beijing and a few other places. But they've got a long way to go. The business climate, the messages are mixed. Just last week, there was a big meeting. I guess it was Thursday night in Beijing. Xi Jinping met with CEOs of a large number of global multinationals to try to address the concerns that you raised. And I do think in the upcoming November 9th to 12th meetings, some of the reforms will be aimed at underscoring, if not enhancing, the incentives for foreign-directed FDI.
So what was the strongest point that the business leaders made to Xi Jinping?
I was not at the meeting. I think the message that I received from several who were there was just that they definitely want to see the new leadership press ahead aggressively on the reforms that are driving the type of rebalancing that we're addressing today. They're all heavily invested in China, not just as an efficiency solution for their global platforms, but as a toehold into this, as of yet, undeveloped domestic market, and they want to grow there.
Great. We've got time for 2 more questions if we have them in the audience. Anyone else got a question? Right at the back there.
There's one here.
Okay, and one down there. Okay, we'll take them both.
My name is Dov Heller, and I'm a student at Yeshiva University, and I wanted to ask Ilan if Brazil's employment is reaching full employment, and there's restructuring going on that's slowing down growth. What type of reforms exactly do you see happening that would encourage productivity and boost growth?
We've got that question. We've got one from someone down the front here as well.
Douglas Ellison, UBS. We heard about the dysfunctional politics of the EU and the US. In your special report on Brazil the other week, it seemed to be a theme there as well as how future generations are going to be paid out of the pension promises, etc. So are we getting to a point whereby economic success in the emerging markets is going to be inversely proportional to the democratization?
We'll start with you, Ilan, and I'll ask the other two
Okay.
to finish off as well with that.
First, unemployment was the question there. Population growth in the last 20, 30 years went from 3% to less than 1%. Now it's reaching the labor market, so we are getting less new entrants. So it used to be a very young economy, a lot of entrants, large unemployment. Unemployment is over, and we have few people entering the market. Either Brazil becomes an immigration country that receives people, which has not been the case in the last 100 years, or you need other reforms, which was your question. What type of reforms? Any reform that increase labor productivity if you want to grow. First, we have a lot of bottlenecks in terms of infrastructure. This is something the government has been tackling, but we really need a lot of that. Roads, railways, ports, airports, you name it, logistics, you name it. On top of that, other type of investment which are not linked only to infrastructure. In the medium run, what you really need is to increase the level of education. Today, we have most of Brazilian kids in school, which was not the case 20 years ago, but you need to increase the level. So if you really want to tackle two things, is in the short run, infrastructure, in the medium run, education. The issue about pension funds and the problems in emerging markets, how can you deal with it in a democratic society is always very, very difficult. The usual trick is that you do stuff for the future, where people that are today in politics really don't feel that they're going to be affected, but that means very long run. I can give you an example of a reform that was approved recently, which was a pension reform in Brazil, which will only start for the new entrants. So it will only affect any fiscal issues in 20, 30 years when the people entering today are retired. So that's a way to deal with it in democratic society.
Stephen, very briefly on that democratization question.
That's impossible, but look, it's a complex debate. In China, you've seen, a lot of hints, whether it's the recent public trial of Bo Xilai, explosive growth of the internet, social networking, experiments in local government elections, new transparency in terms of this open government initiative over the last 5 years. But, multi-party elections in China, forget it, not for, a long, long time. Early stages, active debate, and I think China will be able to grow without the breakthroughs that you and others are demanding every week.
Joyce, last word for you.
Yeah. Well, I think there are a number of countries which I would view as success stories given what the political history has been and what the worries were a couple of years ago. Mexico, Colombia, Peru, the Philippines, which just became investment grade. So I think there are lessons learned that countries take away from this is that, the market volatility, the test on democratization, you have to have your own local markets. You can't be fully dependent on external debt. You need to be able to have your own domestic capital market access by your corporations, fund in your own currency, all of these things. But I think there's a number of success stories that I would point to as well, where it used to be all about the politics, and now there have been enough transitions that have occurred that the politics really aren't the issue that's being debated right now, even when they do have changes in government that aren't necessarily always seen as the most market friendly. Then there are other countries like Argentina and Venezuela, where Argentina substitute Venezuela for last year. I mean, it almost looks the same thing. You're watching how will a transition occur? You have a head of state who's ill. What's the process? So I think it's quite a mixed bag.
Great. Well, on that note, I'd like to thank the panel for being so stimulating and covering such a vast territory, half the world economy in half an hour. And I'm going to hand over now to Philip Coggan, our Buttonwood editor. So thank you very much to the panel.
Please welcome Philip Coggan, Buttonwood columnist and capital markets editor, to the stage. you.